It's just going to be the guesswork which will continue as to what would be the cabinet formation, all the khuspus in terms of what markets, in how things would actually move. Sunil Singhania, how would you rate the market now, given that there would be a change of gear both in terms of risk, P, and also in terms of how the economy would now move for next 5 years?
Good morning, Nikunj. So yes, I think the verdict is slightly lower than what markets expected. But you have to also look at it from the perspective that till last week, I think markets was expecting NDA to get 300 to 325 seats and BJP somewhere in the region of 270 to 290 seats. So it's 10% lower than what was expected. I think what has happened in the interim is that the exit polls raised phenomenal expectations. And even now what you're seeing as a correction is largely what we went up on Monday. Actually, if you see from Friday to today, we are down like 2.5%. So it's not that, it's been like a major thing. The other thing is it's so easy to sit in our offices in an air-conditioned cabin and immediately in 1 hour come to a conclusion that now fiscal deficit will go up and there will be a setback in terms of growth and so on and so forth. I think it's not as simple. If you go back in 1999, BJP won 182 seats and Vajpayee ran a 20-party coalition for 5 years. And the development that time was actually the heralding of the huge movement in infrastructure, telecom, divestment, and so on and so forth. The other thing is, the incumbent PM, Modi ji, had clearly said yesterday that focus on development will continue. So it's very easy in 1 hour to come to so much of conclusion. I think the best thing is to wait for 2-3 days, let everything settle down. It's a very strong coalition. It's not a weak coalition. It's not that 30 parties are coming together with 2 to 3 seats, which is the case of the opposition right now, and trying to inch up a coalition. It's, one major party with 240 seats and 2 major coalition partners with some smaller ones. So I think let's see. It's too early to call that this will happen and that will happen.
Sunil, this entire theory that time to go back to rural focused companies, capex could take a back seat, there would be a big change in terms of how the policy orientation would move. Would you dismiss that or would you align with that?
See, Nikunj, from time to time, our job is to appear smart. And, all these are a reason of that. I think the main reason why some of these stocks have fallen the way they have fallen is valuations. Obviously, yes, there are high beta stocks which are linked to economic growth and development, which would include the capex stocks, some public sector companies, defense, railways, and so on and so forth. But I would say the primary reason why they corrected so much on Tuesday and continue to do so today is largely because even after the fall, they are still fundamentally very expensive. So it is logical that if you have a verdict which is lower than what you expected, the high beta ones would be the biggest losers, and I think that is what is happening. But suddenly for all the consumption stock to go up is largely a function of the fact that relatively they had become cheaper, and second is the positioning was very light in there. So it's a temporary sort of readjustment of the portfolios which is happening, and this always lead to swings on either side.
Get that point, Sunil. But given that you're saying that the primary reason for the fall is valuation, where is it that A, you have valuation comfort, and B, where are the pockets where you think the valuation compression is still going to take some long time to come before it comes to some sort of sanity?
Frankly, it's too early. As I said, Nifty has fallen like 2.5%. Even if you take the up move of the FMCG, which would have contributed to some stability, maybe the broader markets are down like 3-4%. So it's not that, something which was available at 100 is now available at 50. As I said, some of the public sector, defense, railways, and some smaller PSUs had run up much ahead of their fundamentals, and even after the fall, I would say they are much ahead of fundamentals. So just because stocks have fallen, we don't see a significant value. I would say from our perspective, what we are doing is just sitting tight, just waiting for things to unfold. Obviously, evaluating the portfolio is a regular sort of a job for us. On a daily basis, we do it. So yesterday also, last night also we were sitting, till morning also we were sitting. But at this point of time, I don't think there is need for massive rejig, at least for fundamental focused portfolio managers like us. As I said, markets are not like crazily down. They are 2.5% down since Friday. Year to date, they are still positive, and that is nifty. And if you look at funds would be positive anywhere between 5 to 10, 15% depending on their performance even now year to date. Yes, if you are significantly overweight some of the stocks where you yourself did not have valuation comfort, there is merit in using any bounds to restructure your portfolio. From our perspective, we had continued to hold on to our tech weight despite short-term underperformance because it adds stability to the portfolio. We had increased our weightage to pharma to some extent. I think the only place we are underweight is consumption because by nature we are a little bit value conscious, and most of the companies there used to trade at a slightly higher multiple. But obviously in this kind of a scary scenario which is being built in, they are the ones who are doing very well, including today.
Okay, it's a great point that you can look at yesterday's gut-wrenching fall and say, okay, hell broke loose, but you can add back the Monday's gain, and if you look at the market right now, 1 month change actually is not even 2-3%. Since you mentioned that you're sitting tight and markets have fallen because of valuations, do you think the valuations, they need to correct a bit more, or markets could get into time-wise correction for next 2 or 3 quarters where you should be mentally prepared for no returns?
So Nikunj, one segment of the market is definitely still overvalued, and I think that is there is room, and I would say that you'll have those choppy movements of stocks falling, rising, but there is still room for them to correct even further. And therefore, anything to do with capex, anything to do with, as I said, the favorite sectors like EMS or railways or defense or XYZ, I think there is still significant room for correction. But at the same time, if you look at the macroeconomic, you had 8% GDP growth, which has happened after a long time. Your GST collection go up again by 10-11%. Monsoons are normal. I think fiscal deficit is under control. And all this talk that because of 295 seats, your fiscal deficit will shoot up and so on and so forth, are all views taken instantly. I don't think there is any reasoning or any indications to show that. So my frank advice would be that next 4-5 days, it's an uncertain kind of a scenario, largely because everyone wants to react instantly at the same time, which is what happened on Monday as well as Tuesday. If you see today, markets are settling down. I think let us wait for 2-3 days. Maybe by Friday you'll have clarity on NDA coming to form the government, Modi 3.0. You will have a little bit of clarity on who is going to man which ministries. There will be definitely statements being made by Mr. Modi as well as some of his senior colleagues on how they see the economy going forward. And I think the narrative is all instantly next week going to shift to the budget, which should be coming up in July.
Sunil, why have banks fallen? I mean, whichever way things are moving, that sector is in a good shape. Most of the banks now have a strong retail focus franchise. The earnings are strong, GDP is decent, inflation is under control. I can understand that policy related stocks, capex stocks, defense, railways, they felt the heat of the election mandate. But the bank nifty yesterday was down 7%.
Because on Monday it was up 7%. So it's as simple as that.
Okay. Could private banks be a good go-to space now?
No, I think valuations are one of the cheapest ever, and as you rightly said, fundamentals are good, credit growth is good, we are looking at a scenario where interest rates sort of have looked like peaking out. On PE basis, a lot of private banks are available at 9, 10 to 11, 12 PE multiples. We have never seen such great franchises trading at like 11, 12 PE. And we are definitely invested, and we would continue to look at them if we get an opportunity. But that's a good space to be in.
All right, Sunil, going to let you go on that note. Appreciate you taking the time out and giving us your analysis of the market move as well as where you're seeing opportunity at a time like this.
If you like this video, then like, share and subscribe to ET Now.